Hello everyone, welcome to Kotak Wealth's market update for September 2018. I am Shobhit Mathur and with me is Naren, Chief Investment Officer, ICICI Prudential Asset Management Company. Hi Naren.
Hi.
Naren, let's jump on to the fundamentals first. We've seen crude oil becoming the news and that's having a big impact on our rupee. How do you see these global macros panning out over the next few months?
I think it's very critical because crude oil going up creates a big import bill for India. $1 going up leads to almost $1.5 billion of import bill going up. So obviously the impact of crude oil going up is substantial on Indian economy. Our view on crude oil has been that near term is likely to be bullish for crude oil, but in the medium term things should settle. So I believe that the next 6 months to 9 months is a very difficult period for Indian macro, given the way crude oil has moved and the way US interest rates have also been moving up.
So adding that to our own deficit situation and how government in the election year would have, in an ideal scenario, wanted to spend more and recently announcing cut in their borrowing calendar. Do you see that macro impacting our fundamentals in some way?
Clearly, if you look at the way the situation is evolving, I believe that the macro is clearly influencing the fundamentals. I think the easy money environment which existed doesn't exist. And we are seeing yields across the board going up, particularly the borrowing rates of most of the borrowing entities have been going up, and it's no longer easy to borrow cheap in dollars. So I think the cumulative is a complicated macroeconomic environment as we speak.
And then if I add that to our local set of issues in terms of what happened with ILNFS and the subsequent problems in NBFCs, how do you see that pan out over the next few months?
See, there are 2 points. One is, depends on how you're positioned. Let's assume you're underweight many of these things. Our reading is that you normally invest when there is blood on the street. So from that point of view, if you ask me if you're well underweight, then there is a case to slowly look at adding over the course of the next 1 year as the situation evolves in many of these areas, coupled with, there are enough global and local reasons for volatility. On the other hand, if you're in 2017-18, if you've taken your equity allocations in small and mid caps to a very high level, then you are faced with a tough situation of having to cut after the fall. And that's something you may still need to do because it's not as if valuations in mid caps, for example, are dirt cheap at this point of time.
Okay. So coming back to the valuations, and the most important hypothesis that we hear on the street is that we are in for a strong earnings growth. Do you see that happening now for the next 1-2 years?
See, when we look at things, what we find is that there are areas where earnings can be good. But if you look at dollar going up like this, if you exclude the export and import substitution areas, there are many cases where dollar turns out to be an input or a source of borrowing on which you have not hedged or you have hedged. So I would say within a limited basket of exports, manufacturing, I think it's pretty good. The earnings environment is very good. Selectively in banking, which is built on strong funding franchises, things are good.
And you briefly mentioned about mid-cap valuations not being cheap. Would you still venture to look at mid-caps now, or maybe wait for another few months and start looking at them in a constructive way?
See, actually the problem is that there is just too much over-ownership in mid-caps. And, in the last few years, people came to this strange perception that mid-caps will always outperform large caps. And many people are over-invested in mid-caps. Frankly, the problem is not with mid-caps. So I think over the next 10 years, will they do well? They'll do very well. Will they deliver better returns than large caps over the next 10 years? Certainly. The question is, it's a question of allocation and risk. I think if the risk in mid-caps is much higher than large caps. And if you're very over-allocated to mid-caps, today the 5-year returns are still 150%. So even if you take out money after today, you're taking out after a 5-year 150% move.
So Naren, one last question to guess your estimates of markets and interest rates and maybe gold and currency over the next 1 year. Where would you approximately position them at?
See, it's difficult to give numbers, but I would say that, if oil keeps going up, there's no reason why interest rates can't go up another 50, 75 basis points, making short duration debt an attractive asset class. I believe that gold hasn't delivered returns for years, so why can't gold outperform all the other asset classes over the next few years? Otherwise, I would say we are in an atmosphere where there's no reason to be extremely taking high risk asset allocation. Maybe just after elections or something like that, one can relook at that framework and decide, boss, now we can go to a much higher risk strategy from an asset allocation point of view. I think 2013 to 18 January, risk helped. I think there is a year ahead where I think moderate risk may actually work better than high risk at this point.
All right. Thank you. Thank you, Naren. That was quite helpful.
Thank you.
Our next guest is Upasna Bhardwaj, Senior Economist, Kotak Mahindra Bank. Hi, Upasna.
Hi.
Upasna, starting with the macro fundamentals, with crude oil and rupee movements, how do you see this situation panning out for the next few months?
Yeah, so I think India's fundamentals are highly correlated with the way crude oil prices move. And clearly that is what is getting reflected right now in the currency move. So if we look at the impact, then we tend to see about for every $10 move in crude oil prices, current account deficit tends to widen by $12 to $13 billion. And along with that, we tend to see the impact on inflation by about 30 basis. I'm talking about CPI inflation. Overall, because of the terms of trade not turning favorable, the GDP also tends to get impacted by about anywhere between 15 to 25 basis. So all in all, the fundamentals do get impacted. Now, what's happening is in the beginning of the year, when we started the year, crude oil prices were closer to 65 per barrel, a dollar, and that has moved closer to 85 dollars a barrel. Now, clearly, if you look at the shift, it's a $20 shift. That is obviously expected to shake the entire fundamentals of India's story. Now here what's happening is that the current account deficit largely is increasing immensely. If we compare to 2013, the current account deficit in absolute term was around $88 billion. We seem to be moving closer to that level now, which means somewhere around 3.2% of GDP. Now, if and this is at $85 a barrel at crude. If we were to see further upside risks to that, then clearly we will see the current account deficit moving higher than that, and that is something which is obviously having a bearing on rupee. I mean, if you see the rupee, it has been the worst performer amongst the Asian peers, despite a strong growth, inflation relatively under control. Yet, because of the dependency on oil, INR seems to be the worst performer in this calendar year. So clearly, I think crude oil prices becomes extremely crucial for India's fundamentals.
So now, correlating that crude oil movement with the currency, how does this really impact our inflation, and what is our expectation of inflation for the next 6 to 12 months?
Yeah, so actually, so there are two parts to this. One is if you look at within the 3 to 6 months, inflation, CPI inflation is still relatively under control, I would say. It's somewhere in the range of 4.5% to 5%. That kind of provides a comfort because food inflation as of now is fairly benign. And that is something which at least will keep the overall headline CPI inflation trajectory under control. Of course, if we were to look at RBI's comfortable level, then that is 4% inflation. But 4 to 5% inflation in this kind of environment seems to be fairly comfortable. So in the 3 to 6 months, I would not say that inflation is too much of a worry. Having said that, if we look at every 5% depreciation in the currency, that tends to translate into about 25 to 30 basis of an impact on inflation. Of course, it comes with a lag. It's going to come directly through the WPI and then from WPI to CPI. So gradually it seeps into maybe 6 months it takes before it starts seeping in. So that is where we will start seeing the upside risk to inflation into FY20. And that is where we'll have to be worried about. But as of now, within FY19, I think inflation is well controlled within 5% range.
So then coming back to what the monetary policy should be in this background where inflation remains under control, but we have our external variables which start to matter. Do you think RBI will want to now turn a little away from their inflation target trajectory?
See, I think RBI is obviously, the challenge for RBI is increasing immensely because, as against a traditional growth and inflation dynamics which RBI is supposed to be monitoring, now the financial stability is at stake. And hence, I think somewhere, given the external sector dynamics, RBI will have to be very, very watchful because, RBI is a forward-looking central bank and they need to look at the risks, which side of the risks skewed to on the inflation trajectory. Now, from a 4%, we are already talking about a 4.5% to 5% in the next 3 to 6 months. And to that, the risks are skewed on the upside. So clearly, with the rupee depreciating in this manner, the upside risk to inflation is increasing, and that will become even more manifold as we step into FY20. So clearly, the upside risks are significantly high, and that should keep the RBI on the tighter side. So definitely the policy stance has to be a little on the tighter side. We cannot afford to be on a little accommodative side at this point in time, especially given the global volatile scenario, wherein the other emerging economies like Indonesia, for instance, has hiked almost 150 basis of policy rates. So in such a kind of a scenario, when Fed is hiking, other emerging economies are also hiking, we cannot afford to be a little on the accommodative side. So I think somewhere the stance has to be a little on the tighter side. But having said that, at this point in time, inflation is yet not aggressive enough for us to warrant an aggressive monetary policy tight stance.
Okay. Coming back to the other parameter which has been creating disturbance in the debt market, which is the liquidity. And we know that post the advance tax market is deficient on that piece. What do you think will be the way forward on that?
Yeah, so I think one is, of course, that the second half of the year, seasonally, we tend to see the banking systemic liquidity requirement increase. So we tend to see a tightness in the liquidity system within the bank in the second half of the year. Now, if you look at the way things were expected to pan out, currency in circulation was supposed to be going out by almost 1.6 to 1.7 lakh crore in the second half of the year. And along with that, of course, the government, which has already spent much more in the first half of the year, would have gradually started reducing the spending. So, that was also providing a liquidity buffer in the first half of the year. That also starts coming to a halt. And to add to that, of course, because of the weakening currency, we have RBI's intervention also happening. So I think all in all, we were in any case expecting a significant tightness in the liquidity situation in the banking system in the second half of the year, because of which we were expecting a fair amount of primary liquidity infusion by RBI for sure. Despite RBI maintaining a policy stance on the tighter side, we were still expecting some kind of liquidity infusion, most likely in the form of OMO purchases. And so that was on board. Of course, the situation has worsened of late because of the recent liquidity crisis, or rather the credit squeeze that has happened in the NBFC space. That, of course, has worsened the situation, and that probably would warrant much more pointed, specific measures by RBI to tackle the problem. Not necessarily a blanket primary liquidity infusion would suffice there. So they would have to probably take individual specific measures to tackle that problem. So, like I mentioned before, the inflation risks are there over the 6 to 9 month horizon. Upside risk. The crude oil prices don't seem to be, anywhere showing signs of abating.
So, would you recommend short maturity portfolios then?
Yes, I think I would say the risk-reward ratio is probably more skewed in favor of the shorter duration at this point in time.
Okay. All right. Thanks, Upasna. Thank you for joining in.
My pleasure.
That sums up this month's market update. Do write in to us for any feedback or suggestions, and we will look forward to seeing you next month. Thank you.